Now today we're going to be doing cash flow statements. I think you'll find it's quite an interesting topic, something quite useful for you. So at the end of this lecture, you should be able to prepare a simple cash flow statement for a trading firm. But before we do that, I want to just ask you a question. Why do you think cash is important to an organisation? We talk about cash flow statements. Why is cash important to an organisation, do you think? Anybody?
Because in the company, cash is like the blood of human.
Yes, yes. And what does that allow a business to do?
The business can use cash to buy anything they want.
Yes.
And sell something.
Yes, yeah. No, look, that's a good start. In fact, cash is extremely important to an organisation's survival. It needs to repay its debts, whether it's got a bank loan or whether it is to pay creditors. It needs cash for that. It needs cash to grow the business, because even though businesses do operate on credit, they still need cash to grow the business. People, their shareholders, like to receive dividends. Most of the time that's paid in cash. And also, an important thing is that users of financial information, they like to see that companies have got cash because it gives them a bit of confidence. Those users, like a bank, who might want to lend the business money. People like creditors, the suppliers, who want to make sure that they're going to get paid. So cash is extremely important. Okay. There's 3 basic steps to preparing a cash flow statement. The first is that we have to identify cash and non-cash transactions. We need for each transaction to identify, first of all, whether it's cash, and then if it is cash, what activity in the cash flow statement does it belong to? And we'll speak about those activities in a minute. But the cash flow statement, the way that we set it out, you've got various activities. And thirdly, is to prepare the cash flow statement in accordance with a designated layout. Okay, so let's look at this first step where we have to identify cash and non-cash transactions. I think it's on page 172 of your textbooks. So non-cash transactions are those transactions that do not directly involve cash. It seems simple enough, but sometimes it's a little bit more difficult to actually establish that. For preparing the cash flow statement, it's important to know what's cash and what's non-cash, because it's only the cash items that apply to the cash flow statement. Now, as you remember, up to now, we've been dealing with the statement of financial position and the statement of financial performance. And both of those statements are based on the accrual method of accounting. Cash is different. Now, most of these non-cash transactions relate to what we call the operating activity section of the cash flow statement. And they are basically the difference in timing between accrual and cash-based accounting. That's where most of them come from. We'll have a look at some of those in a minute. Some examples of non-cash transactions. Depreciation on plant and equipment, because depreciation is simply a journal entry that companies make to take up the depreciation component of the use of an asset. Things like revaluations of assets, doubtful debts, accrual